Well, good afternoon, good morning. So I'm glad to be following on from Danny and Jan because, among other things, they made some points that my talk will relate to. So rather than doing what Jan says we should be doing, we're moving in a different direction. We're underwriting the central banks, and particularly the Federal Reserve, but other central banks, are underwriting the global expansion of dollar-based finance. And the question that I want to ask is who gets the benefits and who pays the price? But first I want to thank Chandra and Jayati for organizing this wonderful conference, and also to Aaron Medlin, who's sitting over there, for extremely helpful discussions on these issues. So US dollar hegemony persists. That is, we don't have local currencies running the system, as Jan was talking about. What is the role of the Federal Reserve as the underwriter of the dollar system? Who benefits, who loses, and what are the better alternatives to this system? That is, for example, the kind of proposal that Jan was just talking about. Here's some basic data on the international role of the dollar compared with the US's share of world trade. On the left, the red, global GDP, and we can see that the US dollar plays a much higher role in the international economy than is warranted by either their world trade or share of world GDP. In terms of, on the right-hand side, over 50% of foreign exchange transactions, official foreign exchange reserves, and so forth. Notice particularly the foreign exchange transaction volume, which I'll come back to. The US dollar remains the dominant currency in these foreign exchange transactions. That's the big blue line. They're both 1998 and still dominant in 2022. Second is the British pound. And other currencies, including the Chinese yuan that makes an appearance in 2022, is pretty minimal. So this is the growth of the global foreign exchange market from 1998 to 2022. And in billions of US dollars, it grows rapidly. But I want you to pay attention particularly to the blue lines, the blue bars, foreign exchange swaps and currency swaps. These, as we're going to talk about, is a main pressure point in the global financial markets where the Federal Reserve and other central banks are called upon time and time again to underwrite this system to prevent it from collapsing, and are thereby giving a no strings attached bailout to this global dollar system that keeps expanding, and we'll see some problems with that. I already saw that. Increasingly, these kinds of foreign exchange transactions do not occur between banks and other financial institutions and non-financial institutions. That is, they don't support trade directly. What they are in financial transactions. There's hedging to reduce risk, but also there's enormous amounts of speculation. So it's a system that drives financial markets, financial institutions, and speculation. Now, just to make sure that we're all on the same page here, just very briefly, a foreign exchange swap, which plays an important role in my discussion, is an agreement to simultaneously borrow one currency and lend another currency at an initial date, then exchange the amounts at maturity. The point of this is to allow those who need dollars, and since the dollar is the center of the system, businesses and banks all over the world need dollars. This allows them to hedge their borrowing of dollars. But while, like any other financial product, it also allows for speculation and for increasing leverage on the basis of this. Now, one of the things that this market does, it not only facilitates the taking on of dollar debt by agents around the world, but it also hides a lot of the dollar debt that is outstanding in the global economy. The reason this is important, because occasionally, as I said before, there's crises of liquidity in financing this dollar debt, and the Federal Reserve and other central banks have to come in and support it. Bailouts, no conditionality, no strings attached. And a lot of these, probably can't see this, but a lot of these are off balance sheet. So we don't know where they are where this dollar debt is. A lot of it is with non-U.S. banks and non-banks themselves, other kinds of institutions like pension funds and so forth. And so when there's stress in the system, as there has been a number of times, the Federal Reserve and the other central banks don't really quite know where it is. This is similar to the situation of the great financial crisis of 2007, 2008. So what keeps this dollar-based system of financial trading going? Well, there's network externalities. It's being used because everybody's using it. There's the military and diplomatic power of the United States. But as I said, there's massive intervention by the Federal Reserve. The Federal Reserve operations as the international dollar underwriter of the global system. This term there's been other terms used, more typically the international lender of last resort. Kindleberger and others use that. Dealer of last resort, which PERI Merling talks about, because a lot of this is not bank-based lending, but it's capital market-based lending, and you need dealers to intervene and intermediate it. You have the debt buyer of last resort that Robert Macaulay of the BIS talks about, when in fact, as I'll say in a minute, in 2020, when the pandemic hit, the Federal Reserve actually bought corporate bonds and even junk bonds to support those. Now, a key factor about this whole system, this whole global monetary system, is that it's a hierarchical system. And many economists, starting with Duncan Foley many years ago, talk about and describe this hierarchical system of international finance. So at the top of this system is the dollar, and underlying this system are the swap lines given by central banks to help underwrite the system, and the IMF, national money, national credit, at the very bottom of the system. And who has access to these swap lines from the central banks, from this liquidity provision from the central banks, makes a big difference. So the system is hierarchical in that the rich countries have a lot of access to this free money, this liquidity support, whereas developing countries, emerging market economies, have less access to it. So Fed swaps, that is when the Federal Reserve exchanges dollars with the central bank, say the Japanese central bank. The Japanese central bank gives the Federal Reserve yen, the Federal Reserve gives the Japanese central bank dollars, then the Japanese central bank can take those dollars and lend it out to local banks, local insurance companies and so forth, who need those dollars to pay back the money that they borrowed in dollars. These Federal Reserve swap lines, which are helping to underline the system, are mostly going to the European Central Bank, Bank of England, etc. And there are a few of these that go to some emerging markets, economies, Mexico, Brazil, Singapore, etc. But most of it is for the richer countries. So if the less developed countries get into trouble, what can they do? Well, they're dependent on the central banks in the United States and Europe to bail them out. They can use what's called the repo market to give their treasury securities and get loans from those, but this is much more expensive and much less certain. So central banks from developing countries, emerging market economies, are lower down in the hierarchy. And the Federal Reserve has been underwriting the global dollar system first in the 2008-2009 financial crisis, then in March 2020 when the pandemic hit, with these swap lines and these repo supports as well. Now, it appears that these measures in those two periods did calm global financial markets. What's not to like? It's working, it seems, to help calm these crises that come up. Now, Perry Merling and other people who work in his type of macro finance called the money view, it's not the same as modern monetary theory, it's a different view altogether, argues that the Fed underwriting of the dollar system is what we need to do. There's no real alternative to the dollar market-based system. Countries with underdeveloped financial systems can benefit by getting more integrated into this dollar market system. So what we need to do, what the Federal Reserve needs to continue to do, is stabilize the system, allow it to expand and to grow. Now, sometimes these advocates of this money view seem to express a bit of nostalgia for the private bank plus independent central bank plus BIS, Bank for International Settlements, run system of the pre-World War II period, which was a clubby affair, which brings me to the book I just published called Busting the Bankers Club. What is this clubby affair? This clubby affair is a club of the big financial institutions, Goldman Sachs, as Jan was talking about, and other global financial institutions, and the supporters that they have to help them promote their policies, to expand their business, to increase their profits. In this book, I talk about the Federal Reserve as being chairman of this club. The key government institution that helps underwrite the expansion of the private banking system and the mega banks. So if we think about this writ large on the global scene, which is what we're talking about now, the Federal Reserve is playing this role of helping the private financial institutions expand on a global basis. But what this has led to is developing and emerging market countries trapped in an unstable and disequalizing system over which they have little control. So for example, what we know that there's this global dollar cycle, that when the Federal Reserve raises interest rates, because of the international role of the dollar and the dependence on the dollar, this leads to a downward trajectory for many emerging market and other developing countries. In this graph, the blue line is the dollar exchange rate, and the green line is an index that Helene Ray and others have developed to show the financial stress in other markets around the world. This is in periods of high interest rates, as we have now, and in periods of low US interest rates in this dollar system, hot money flows invade many emerging market economies. So the question, if we're thinking about how to deal with the overhang of debt, the need for financing to help countries with the green energy needs and to deal with climate change, what are the options for developing countries currently low down in the dollar-denominated monetary hierarchy? Well, there are four options for developing countries as I see it. One, improve developing economies' access to these Fed swap lines, repo facilities, and other underwriting activities, so that when the stress happens, they get better access to support from the central banks of the world, the Federal Reserve. A second option is to limit interconnectedness with global dollar-driven financial markets by imposing capital account regulations that help with the development of financial institutions locally, more limited and control access to global capital markets. So help to build up the domestic economy and protect developing countries from the hot money inflows and outflows driven by this dollar cycle. A third is to join another network, that is to align themselves with a China-led network of global finance. A fourth is to continue to fight for global facilities that will help provide insurance and liquidity support for productive trade and financial activities in the global markets. Jan's idea is along those lines, a kind of global facility, a global clearinghouse. But as long as we continue to have this dollar-dominated system underwritten by the Federal Reserve and the other world central banks, as the private banks like Goldman Sachs, as Jan was talking about, and other private banks are going to continue expanding, the traders in these markets are going to continue making more money and profits. And this is going to continue to crowd out other solutions to this problem that are more beneficial to developing countries and can really help deal with this problem that we have of financing the attack on climate change. Thank you very much.